Janet Yellen out today, another speech saying basically, barring a data surprise, it would be appropriate to raise rates this year. So should we assume that the Fed's base case is a rate increase in 2015?
I would say it may be appropriate. If you look at the dot charts that we came out with after the June FOMC meeting, where we put the forecast for where interest rates might be going, all but two of the participants thought that we would be raising rates sometime towards the end of this year. Some differences on when the first tightening would occur. But that is conditional on the economy actually continuing to improve. So there were two conditions that we have for actually lifting off rates. One is continued improvement in labor markets, and so far that's been happening. And the second is that we are reasonably confident that inflation gets up to 2%. So far, that's the part of the dual part of that statement that hasn't worked out quite as well.
So,
but,
Eric,
ahead,
you made a very good case against raising rates back in the spring. And one of your points was that the big drop in consumer spending we saw in the first quarter also occurred in regions that weren't hit by super cold weather. And you said maybe this is something more persistent, a result of the Great Recession. We had a strong retail sales report in May, second month of the second quarter, and a lot of people are looking for a stronger quarter. Are your worries fading too? Is that helping to grease the skids a little bit more for that lift up even in September?
Well, as you highlighted, consumption's come in a little bit better in the second quarter. That's certainly very good news. Part of the weakness that we saw in the first quarter, as you're highlighting, was the fact that consumption was pretty weak during that first quarter. I would say even though the second quarter looks like it's going to be a little bit better, given that it should have been some snapback if it was mostly weather-related, I think we'll still have to see a couple more reports before we're confident that consumption's going to continue to be strong. Most forecasts actually expect consumption will be reasonably strong over the second half of the year, and that would be the kind of condition to get labor markets continue to improve.
Well, if we continue to see labor markets come in about where they have been and the unemployment rate stay the same or go lower, could you vote for a rate increase in September given the inflation figures we have now?
I would want to see what kind of data we get over the course of the summer. So it makes sense to wait until we actually have to make the decision. We're out of the realm of giving calendar guidance, and I think we actually do need to be data dependent. So while the data has been coming in better, I think we still have to see what kind of inflationary pressures we're starting to see as we get into the September meeting.
Does it have to keep getting better, or is where we are now good enough if you see evidence it continues?
Well, right now we have core PCE inflation at 1.2%. That's pretty far from 2%. So we need to have some evidence that we think it is going to move up towards our 2% goal. That could be that labor markets can continue to tighten and we get some confidence from that. It could be that we start seeing wages and salaries picking up a little bit more. So there's a lot that could go on over the course of the summer. Certainly if things continue to improve, if we start seeing prices starting to move up from the fairly low level they're at, then it may be appropriate to do it sometime this fall.